You may know I have a banking organization. The consequence of that is I spend a reasonable amount of time when I can talking at least to lower level people at the Fed. I don't get to talk to the big bosses in Washington. They wouldn't like me anyway. The people at the lower level of the Fed, I think, reflect the Fed's bias that the only thing that stands between the US dollar and oblivion through inflation is them. They see no fiscal rectitude in Congress or the president. And I think the Fed as an institution believes that this is not the right time to cut interest rates. They believe that the economy is stronger than the politicians would like to believe. They believe, too, that the incipient rate of inflation is much higher than the rate of inflation stated by the CPI. And they don't want to make the rates more steeply negative, really negative, not relative to the CPI, but really negative for depositors. So I think the institutional bias within the Fed is not to reduce the rate. The Biden administration, which would very much like to win the next election, would like to see rates lower, as would Republican congressmen. There seems to be bipartisan support for doing the wrong thing from a policy perspective. But I think thus far the Fed has done within its mandate, I think, a relatively good job and would like to continue to maintain higher interest rates. The market doesn't seem to believe that they will be able to. Today's pronouncement by the Fed was neither bullish nor bearish, or hawkish nor dovish, depending on which sort of animal you prefer. But I think it signaled to the market that it's likely that there will be a Fed pivot. If there is a Fed pivot, if we see lower interest rates, I think that the action that you saw in the metals will be muted compared to what's to come.
In a recent discussion, seasoned investor Rick Rule sheds light on the Federal Reserve's stance, hinting at potential economic shifts. He reveals insights from his interactions with lower-level Fed officials, indicating a reluctance to cut interest rates despite political pressure. Rule highlights a concerning discrepancy in inflation perception, emphasizing the CPI's limitations in reflecting real-world expenses, particularly taxes. His analysis suggests a significant loss in purchasing power, estimating around 7% annually. Moreover, Rule indirectly suggests potential bullish implications for gold and other precious metals in light of potential Fed decisions. Brace for potential market reactions as the Fed navigates a complex economic landscape.
Right. I'm not smart enough to tell you what they're going to do. I can just tell you that their institutional bias is against it. And I think it's important to think about something about the real environment that the Fed exists in. People's perception of inflation, or put more personally, the deterioration in the purchasing power of your savings, particularly relative to the interest that you receive as a depositor or a buyer of treasuries, is more problematic than people think, I believe. People's perception of inflation, including Congress's perception of inflation and the popular media's perception of inflation, is driven by the CPI. I laughingly call the CPI the CP lie. First of all, when it's inconvenient for them, it doesn't include food or fuel. As you look at me, a rather portly 71-year-old, clearly I like to eat. So a measure of the cost of living, which doesn't include food, is of little use to me. Maybe more importantly, it's, quote, hedonistically adjusted, which means that the people who compile the index don't pay attention necessarily to the price that you paid for your house or the price that you pay for rent, but relatively the perceived quality of your dwelling and how that's changed over time. Similarly, they don't look so much at the price of your computer or your software as their perceived value, which is to say that this isn't really an index. What this is a contrived measurement. But the worst criticism I have that I hope your viewers take home with them is that this alleged cost of living index doesn't include the cost of tax. The cost of tax is the biggest household expense that most Americans face, larger than shelter, larger than energy, larger than transportation, larger than food, combined. The cost of living index, which doesn't include the cost of government, I'm amazed that it's considered a good or service, but that's a bit different discussion. The idea that the deterioration of the purchasing power of my savings doesn't include the increasing cost of government, to me, is perplexing. I've tried a thought experiment every year for 5 years where I've attempted to compute the loss of purchasing power in US dollars against the basket of goods and services that I consume myself. Caveat, I'm a rich old guy. I don't need to buy much, so I don't. But I think that the purchasing power value of US dollars in measured against the basket of goods and services, including tax that I consume, means that I'm losing about 7% a year.
Veteran investor Rick Rule delves deeper into the economic landscape, drawing parallels between the present circumstances and the inflationary period of the 1970s. Highlighting the erosion of purchasing power amidst seemingly attractive returns, Rule cautions against complacency, labeling it as return-free risk. He emphasizes the importance of considering traditional hedges against inflation, particularly precious metals like gold, which he believes are poised for substantial gains. Rule predicts a significant upward trajectory for gold, citing geopolitical tensions and a fundamental shift in global economic dynamics as catalysts.
This draws me back to the period 1976 to 1972 in my formative years. The specter of inflation was all about us, but we'd come off 20 pretty good years, and people weren't so concerned about inflation. It took 5 years for inflation to bite them before they understood the deterioration of the purchasing power of their wages and savings. When it occurred to them in 1972, 1973, it occurred to them in spades. But there was a 5-year delay between the appearance of the hallmarks of inflation and the market's reaction to it. And I think that we are precisely in that same period today. Think of yourself as a saver. You buy a US 10-year treasury, which pays you 4.1%, 4.15%. You think, hell, this is a lot better than it used to be, 2%. You measure the fact that they pay you 4.1 in a currency where the real purchasing power is declining by 7. What it means is that you're losing almost 3% of your purchasing power a year every year for 10 years. My friend Jim Grant called that return-free risk.
Right.
And I think people really need to consider this, particularly people who are interested in traditional forms of hedging against inflation, including precious metals. Gold has moved from what, 1800 to 22 and change?
Yeah.
The move is what occurred in the period 2000 to 2010, where it went from
Right.
$250 to $1,900.
Right.
I don't go personally, because I think it's going to move from $2,200 to $2,500. I couldn't care less. To me, that's static. Music is gold moving from $2,000 to $7,000 or $8,000. By the way, I don't want this to occur. The set of circumstances that causes it to occur creates problems in our life, and I would prefer not to have problems in my life. I'm old and fat and rich. I don't want that. But I believe that the set of circumstances is in place that was in place in the 1970s and in place again in the first part of the decade of 2000 to 2010 for gold to make a real move. I don't mean a $30 move or a $40 move. I mean a real move. I believe, too, that what you've seen in silver is more a dead cat bounce than anything else. Technicians would say it formed a long base. What I would say is very different. I would say the sellers got tired.
Right.
You run out of supply when you've taken out all the supply. It's interesting to note in the gold market, which you correctly surmise needs to precede the silver market, the buying in the gold market has not been individuals. In fact, individuals have been a net seller through the gold ETFs. From a contrarian point of view, that's good. That means gold is still hated, despite the fact that it's performing. The buyers of gold have been central banks. The cause of the gold move isn't the incipient understanding of inflation, but rather the weaponization of the US dollar. The stealing of $300 billion worth of Russian assets in US treasuries by the US government does not make other governments, particularly those who might be perceived as hostile towards the US, to continue to hold US treasuries. The weaponization of the US dollar through the SWIFT banking system, the attempt by the US government to export their values extraterritorially through the dollar has led to a circumstance where foreign governments have no choice but to sell their dollars and buy gold. if you combine the impact of the weaponization of the US dollar and the decisions it forces on our trading partners with what I believe is the upcoming realization by all holders of US dollars, including American holders of US dollars, that the diminishment of their purchasing power relative to the interest they receive in US treasuries is negative, that's when you get a move in the gold price, a real move in the gold price. And after you see the real move in the gold price, you'll see a real move in silver prices.
In today's insightful discussion, we've gained valuable perspective from Rick Rule on the Federal Reserve's stance, inflation perceptions, and the potential trajectory of precious metals, particularly gold. Rule's analysis highlights the complexities of economic landscapes and the importance of understanding key indicators like inflation and interest rates. As we navigate these dynamics, it's crucial to stay informed and consider alternative assets, such as gold, as hedges against potential economic uncertainties. We hope you found today's insights enlightening. Don't forget to subscribe to our channel for more informative content. Hit the like button if you enjoyed this video, and share your thoughts in the comments section below.